I have told you that there are two ways in which a depositor can get back his money before the maturity period in fixed deposit. Even though he had deposited the money for 5 years, he can get back the money in two ways. One is premature withdrawal, in which he can totally pre-close the deposit and take the entire money back, or otherwise there is another opportunity in which he can take a loan against a fixed deposit. Now sometimes you may ask the question, which is better for the customer? Whether he should do premature closure of deposit or take a loan on deposit, which is better? Sometimes, this is a very, very important point. Many times customers don't know. They come to the bank, and the bank there is nobody to guide them. As a result, they pre-close the deposit, which will result in lot of loss. They could have easily taken a loan. For example, there is a customer who has deposited 1 lakh for 5 years. And after running for 4 years and 9 months, in the last 3-month period, he comes and says, I want 2 lakhs urgently. And somebody will suggest you pre-close the deposit. They will pre-close the deposit. Therefore, they will lose for the entire 5 lakhs. Interest for 4 years, they will lose. On the other hand, they could have easily taken a loan and deposit, where for which will mean for 2 lakhs, they will have to pay additional interest of 1% only on these 2 lakhs which they are availing. Therefore, which is better, to take a loan or to go for premature withdrawal? So this depends upon the situation. It differs from situation to situation. Suppose the deposit has run for a long period. 5 years is the total period of deposit. It has run for 4 years and 9 months. In such cases, better to go for a loan, because the 1% extra you are going to pay only for 3 months. You will get the full interest for 4 years and 9 months. If you pre-close, you will lose 1% for 4 years and 9 months on the entire amount of 5 lakhs. So it depends upon the period for which the fixed deposit has run. Then number 2, it depends upon the amount. Suppose you have deposited 10 lakhs fixed deposit for a period of 5 years. In the second year, you need only 25,000 rupees or 50,000 rupees. There is no meaning in premature closure. Better go for a loan, because you have to pay additional interest of 1% only on this lower amount. Otherwise, you will lose 1% on the entire fixed deposit amount. Then the third factor which will decide whether you should go for a premature withdrawal or for a loan depends upon the period for which you want the money. Suppose there is a husband and wife. They have deposited 10 lakhs in fixed deposit for 5 years. At the end of the 3rd year, suddenly the husband is hospitalized and they need 50,000 rupees for hospitalization expenses or 1 lakh for hospitalization expenses, and they will get the money back from insurance after 1 month. So they need this 1 lakh only for a period of 1 month. In such a situation, there is no meaning in pre-closing the fixed deposit, because they will lose interest for the entire 2 years or 3 years for which the period deposit has run. Instead, they are going to use 1 lakh only for a period of 1 month or 25 days or 1 month. In this case, you have to advise the depositor, you better go for a loan on deposit. So the bank gives both facilities, namely premature withdrawal and loan on deposit. Which should be used? It depends upon which is profitable for the customer, not the bank. Please always remember, customer first. For the depositor, which is advantageous? It depends upon the period, amount, and the period for which the amount is required by the depositors. So based on these 3 factors, you can advise them, and even in your own interest, if you have some fixed deposit and you want suddenly some money, you decide based on the factors which I have explained. Then there is another interesting deposit about which even many bankers don't know. This is called fixed deposit under capital gains scheme. What is this capital gains scheme? There are 2 types of gains. One is short-term gains and the other is long-term gains. Suppose you buy a share and sell it within 6 months and make a profit of 10,000 rupees. It is a short-term gains on which you have to pay income tax. On the other hand, you buy a share, you keep it for 20 years, and after the end of 20 years you sell, you make a profit. Here the period is not less than 1 year, it is more than, it is expanding itself to 20 years, and therefore here you make long-term capital gains, and therefore you must pay capital gains tax. This applies to buildings. Suppose you have a house which you buy and sell it after 15 years or 20 years, you will be obviously selling for a higher price, and you will be making a gains which is a long-term gains on which you have to pay capital gains tax. Whenever you are selling a house or real estate property, you are given some exemption from paying capital gains tax. You have to pay a capital gains tax of 20% of the gains. Whatever gain you have made, out of that 20% must be given to the income tax department by way of capital gains tax. Now you need not pay this 20% provided you reinvest the amount in buying some other house or in some real estate property. So, suppose you sell a house worth 1 crore. You had purchased it for 10 lakhs. So the remaining 90 lakhs you have to pay capital gains. At the rate of 20%, approximately it comes to 18 lakhs. Something around, some indexation and all those things are there. Taking into, you may have to pay approximately 15 lakhs by way of tax. Now this 15 lakhs you need not pay provided you reinvest this money in buying another house or constructing another house. Now you cannot buy or construct a house overnight. You have just now sold the house. You have to find a new house. It may take some time. Till that time, what you can do? You can keep the money in a fixed deposit scheme with a bank under a special deposit called fixed deposit under capital gains scheme. In case you keep the amount in this scheme, you can take the money and then buy later on a house, or you can construct a house. The period of fixed deposit is 24 months for purchase of a house and 36 months for construction of a house. Please remember, under this fixed deposit, no loan is payable. You cannot take a loan against this fixed deposit. That is prohibited. Then, at the time of withdrawal, you should produce the income tax order which stipulates how much money should be used. A lot of instructions will be contained in that order, and the bank will follow the instructions as contained in the income tax order. So please remember, in all such cases where FD for capital gains is done, you have to close and hand over the money to the depositor only as per instructions of the income tax authorities. There is also a proviso that you need not open a fixed deposit. Suppose you need only for 1 month or 2 months, you need not even open a fixed deposit. You can also open a savings bank account for capital gains scam. But fixed deposit for capital gains is a very, very good deposit scheme, very useful for the customers. As a banker, if you tell them that anybody who sells houses is to get a lot of cash, he doesn't know what to do with the cash, you can ask him to keep it in fixed deposit, earn interest till he finds an alternate house to buy, or he starts construction of a new house. So this is a very good scheme. The questions may be asked on this fixed deposit capital gains scheme, like whether a loan is permitted. The answer is clear, answer is no. And how you should repay it? Only as per instructions of the income tax department. Then when we are talking about fixed deposit, one very important factor should also be brought to our attention. That is called tax deducted at source. In the 1980s and all, there was no tax deducted at source. Suddenly one fine morning, income tax woke up to this new way of collecting money easily from the rich people, and what they said was, on all fixed deposit, if the interest earned in a year is above 10,000 rupees, then tax must be deducted at the rate of 10% and remitted to income tax department. Later on, the depositor has to file his income tax return, and whatever is the interest rate income tax that he has to pay, it will be adjusted. The amount that is already paid by the bank in advance will be adjusted against his actual income tax which he has to pay. But here the responsibility to deduct in advance at source is given to the bank. What are the conditions? For a financial year, if the interest for a person is more than 10,000 rupees, you have to deduct 10%. Suppose there is a customer who is not paying income tax, he is not coming within the income tax level at all. For such a person, there is a provision, they can submit form 15H and 15G. They may ask a question on either 15G or 15H. Suppose the question may be like this: if there is a tax deducted at source, this can be waived, provided which form is submitted. The form that is to be submitted by the customer is 15G or 15H. 15G is for persons less than 60 years and 15H is for persons who are more than 60 years of age, in which they are saying that their annual income is less than the taxable income. If their actual income is less than the taxable income, then they can submit a 15G or 15H, and the bank will not deduct tax at the rate of 10% from their fixed deposits, even though the interest may be more than 10,000 rupees per month. And another interesting feature in this tax deduction at source on fixed deposit is that if you give the PAN card, only 10% interest will be deducted. And if you don't give the PAN card, they will deduct 20%. Therefore, in the interest of every depositor, suppose the interest income is more than 10,000, suppose somebody comes and gives a 10 lakhs fixed deposit for 5 years, it will be obviously, assuming 8%, it will be 80,000 rupees more than 10,000. Therefore, every year you will have to automatically deduct tax deducted at source and remit it to income tax department. So in such cases, we can very clearly advise the customers, depositors, to give the PAN card so that you will deduct only 10%, otherwise you will have to deduct 20% and serve it. So this is a very important point which may be asked in the question. Also this is very relevant for us in our day-to-day life when we deposit fixed deposits which will earn interest more than 10,000 rupees per annum. So far we have seen all categories of fixed deposit. Now we shall see the next type of deposit.